Good morning, Symmetry Nation. My name is Melissa Wiegel, hailing from the Monteith and Watkins hierarchies and director of the company. And just like every single day of my life, extremely blessed to be so. On behalf of all of us on this call, we first off want to thank Brian, Brandon, and Casey for creating this godsend of a company that we are eternally grateful to work with. Today on the call, we are super excited to have Mr. Alex Jackson and Mr. Mark Hammelman, both agency owners, assisting me. These two individuals have been by my side for the last 2.5 to 3.5 years, and I honestly couldn't imagine enjoying this journey here without them. And without further ado, today our topic is have your cake and eat it too, layering strategies. And Mark is going to be first covering the section of the call, and he's going to be discussing the importance of mindset and setting up the why portion of the topic. And then Alex is going to be covering the how to or the implementation of the strategies needed in order to be successfully in utilizing this technique. And so without further ado, the screen is all yours, Mr. Mark Hammelman, and thanks again for helping out today.
Thank you, Melissa. I am Mark Hammelman, director of Melissa Wiegel, and I am very, very blessed and excited to be here and honored to be here on the call. I'll get right into it. Mindset, getting ready for your appointment. Some of the things that I always do when I'm going in, regardless of what kind of appointment it is, you always have to smile and be positive. Being prepared is another key. Make sure you fill out your qualification sheet on your telephone. Make sure you game plan with your mentor if you need it. When you get into the appointment, make sure you're just having a conversation with a new friend. Get to know them. Bring up conversation points with them. Family, job, sports, pictures, etc. Make them laugh. It helps break down the barriers. Don't just be another guy that's wanting to sell them something through the door. Always look them in the eye. Be looking into the screen, and whether you're on Zoom calls, be sitting at the kitchen table across from them, looking into their eyes, not looking away. They're looking for somebody to trust and to be honest with them. They get a lot of the older people, like my father per se, gets 1 or 2 calls a week. They want somebody to trust. Lastly, and on my screen, it says in capital letters, listen. You have to listen to what their answers are. You have to summarize and paraphrase so that they understand that you're listening. So what I'm hearing Jack say is this. So our goal in working together is going to be this. Keep it brief and to the point, showing that you listen. Because the more you talk, the more you lose. Make sure you go through your role and purpose. Make sure it's done at the beginning when you set your appointment up, and make sure you're at the beginning of your appointment, you go through your role and purpose. And then finally, there's some key questions that you always want to ask. These key questions help guide them. And you, once again, have to listen. Why am I here speaking with you both? And sit back and listen. And then ask each person individually, if Jack doesn't come home tomorrow, what are you going to do, Jill? And listen. And Jill, what are you going to do? If Jill doesn't come, Jack, what are you going to do? And understand what they're wanting to do, and then solve the problem together. And then finally, always do a financial fire drill. Don't assume what other people's situations are. And if you're not for sure what a financial fire drill is, we have great examples out there. Get with your upline, and our Summit system walks everything right through it.
Absolutely. Thank you so much, Mark. Appreciate you sharing your wisdom with us here today. And now, Alex, I'm super excited to hear about what you're going to be teaching everybody here today on this call in regards to layering. So take it away, Alex.
All right, Melissa, can you hear me okay?
Absolutely, loud and clear.
All right. Well, Melissa, thanks again for having us on to do this. And Mark, thanks for going over mindset. A few things I want to kind of cover as far as what we're going to be setting up here. So the idea of layering or laddering, they're one and the same, two different words meaning the same thing, is the idea of being able to help a family potentially, if they qualify, get policies, 2, 3, sometimes 4 of them that will end up costing less over time, less in the long run, and give them the same amount of coverage comparatively to what we may have done with a single policy. We'll show some examples of that here in a second. It also makes us what I call stickier in the home. And what I mean by stickier is if a customer, say, has policy 1 and then they can't afford to pay that payment 3, 4 months, 3, 4 years down the road, now they've lost that policy because they couldn't afford to pay it, push came to shove, and they're needing to figure out, well, now what do I do? But if you have policy 1 and policy 2 and maybe policy 3, now you have that customer has the ability to keep 1 or 2 of them, have something in place rather than nothing, versus just losing all of it because push came to shove and they couldn't afford it. The other thing is, like I mentioned in the beginning, it also gives that family the ability to save some of the money by doing smaller policies congruently together versus one large policy. And you'll see with the example I'm going to share with us here in a second, the first one, it's almost a $90 a month savings for what we're going to build as a customized policy. So, Melissa, the scenario that I'm going to be sharing is going to, and I don't want to, I guess I should preface this, Melissa, by saying that we're not biased towards one company, one carrier, whatever, but we all know that we have this new wonderful product with SBLI. But we have to also assume, as some of you are brand new agents, you may not have E&O insurance yet. So SBLI is not an option yet. You may not have written your policies yet. So SBLI is not an option. Or the customer just may not qualify for Elite, Preferred, or Select. And so it opens up some other opportunities with some other companies besides just SBLI as the most cost effective. So we're assuming in this scenario that the individual can't qualify for that Elite, Preferred, or Select with SBLI, or like I said, that you may not have it yet. And also knowing that if you do have it, you can mix and match the example I'm going to show here with maybe you do policy 2 with SBLI and policy 1 and 3 with, say, Mutual or Foresters. So we can mix and match some of these. And also, the biggest thing to remember is we're wanting to help that family get the biggest bang for their buck, not just have a large policy with no money at the end of the month to be able to not be able to spend it. So the first thing we're going to do is we're going to look at, I'm going to share my screen, Melissa, if you can make sure you can see it. And hang on one second. I'm so sorry. Working from home, sometimes kids get involved.
No, you're doing absolutely fantastic. So thank you, Alex, and welcome to live TV here. This is how this works, and the show must go on. So thanks again, Alex.
Sorry, everyone's experienced that before, hopefully. So let me share this screen and technical. There we go. Okay, Melissa, can you see the smiley face? Okay.
Yep, it's perfect, Alex.
Awesome. And by the way, guys, core value number 8, we have fun and we get stuff done, right? You do not have to be a great drawer. You don't have to be a great anything for that matter in order to do these type of policies. So one thing that I do recommend is that if you have the ability to use your whiteboard, definitely use a whiteboard and these can be done, by the way, Zoom. This can be done in the home. This can be done over the phone even, and get with your upline on how to kind of have a customer draw out the policy with you if you're doing it over the phone. So we're going to start with this, okay? We're going to say this family has or needs or wants $300,000 in coverage. You also don't have to have great handwriting, Melissa, to be in this business. So let's say they wanted to do $300,000 in coverage. So for those of you that are taking notes, I'm using Mutual of Omaha for this examples because I just wanted to make it simple and one piece across the board. So $300,000 on a 30-year term with return of premium and RPU. Melissa, if I'm going too quick, please tell me to slow down. This is going to be $230 per month for this customer to get this policy. So again, if you're taking notes, write down 300,000, 30-year, $230 per month with ROP, RPU, and this is a Mutual Term Life Express in this example. So there's what some folks would just go straight to. And then that customer may say, based on that financial fire drill Mark talked about earlier, we know when we ran this and after we did that financial fire drill, 230 is not going to be affordable for this family. So how can we get them $300,000 in a time frame of going down over the span of the loan and still get them a payment that makes sense? So we're going to look at laddering a policy together. So let's erase what we got here. We still want $300,000, right? So let's do $300,000 in a different way. Let's take this and break it down into 3 different policies. So we're going to look at, let me actually erase this, Melissa, so you can see it better. We're going to look at $100,000. Okay, that does say 100,000, not the word look. I had a customer ask me that one time. Say, what is look? This is on a 15-year term. We're going to look at another one, same $100,000. Oops. Same $100,000, except we're going to do this one on a 20-year term. And then this one, we're going to do another 100,000 because that obviously equals 300,000. This one, we're going to do the 30 years, except Melissa, on this one, we're going to do it with ROP. Pen is really thick. With ROP and RPU, and I'll explain what that means here in a second for our new folks. Okay, so we've got this one here. That's going to be $30 per month. This one is going to be $35 per month. And this one with the return of premium is $77 per month. Now, Alex, you mentioned ROP and RPU. What does that mean? ROP means return of premium. That means at the end of this time frame of 30 years, this family has the option to get back off of this policy, the $77 policy. They could choose to get all of that $77 back times 30 years. It's 100% with Mutual as an example. So that's 100% of their money back. Or what I like is the idea that they have RPU. So in this example, they have a $50,000, I call it a hybrid policy, because now they've got life insurance from this, by the way, I should have prefaced with this, Melissa, I'm sorry. This is on me as the example, a 39-year-old male, non-smoker, relatively healthy, height, weights within the charts, okay? So the money back portion is $27,000, which again is 100% of the $77 over 30 years. And this 50,000 goes from, I'll be 39, I'm 39, so I'll be 69 years old. And that goes through the age of 95. And the best part about the paid up part is it means that my monthly payment is $0 a month, because I was healthy, I was younger, I got it when I could afford it. And now I've got a policy that's going to last me until I'm 95 without having to pay for that policy in the future time frame. Now, we talked about how we're going to save the customer money, right? So this right here ends up coming out to, make this really thick, total for these $142 a month compared to $230 a month, which is basically give or take $90 a month saving for all 3 of those policies. Well, Alex, you did 3 policies, but why did we do 3 policies? I know it saved the money, but let's look at the overall, like, why do we do it that way, right? So let's erase all this. Oops. I don't know what happened there, Melissa. Melissa was going to do this, but she said the technical stuff was not in her forte.
Yeah, everybody knows that. So thank you. Yeah.
All right. So let's look at how this breaks down, right? So we've got the 30, the 35, and the 77. So each of these individually are going to give that customer, you see that better, Melissa, zoomed in?
Yeah, that looks perfect.
So each of these individually are going to give that customer 3 separate policies. And the nice thing is they're going to run congruently to one another versus separately, right? So right here, oops, where's our marker at? There we go. So we've got too thick of a pen is what we got. So we've got now all the way through age 95. So let's look at this policy and really break it down. Here's today, this gentleman's 39. And then we're going to have this go out until down the road, right? So this is 15, this is 20, this is 30 years, and this is the ladder from 69 years of age until age 95, where in this example, we have this gentleman still has a $50,000 policy, but the monthly payment is $0 a month. And this is literally how I would draw this out to a customer if I'm drawing it either on the Zoom, in the home, or if I'm on the phone, I'm having them write this out with me. A little harder to do on the phone, but it's still doable. So now I've got this option because they chose option B, which is the reduced paid up. But here, for the most recent time frame of the loan, right, the most crucial, the first 10 years, they've got all $300,000 covered. And then from year 16 to 20, they've got the other 200,000 because they remember 100,000 dropped off. Need smaller fingers. And then for the latter 10 years, they still have 100,000 on the loan or on the coverage because they remember we did one for 30 years. So this one runs congruently with this one, which one runs congruently with that one. And the really cool part is right here, their payment dropped by $30 because this policy drops off. Right here, their payment dropped by another $35, and then they just keep paying the 77 right here. And then at the end of that time frame, they get to choose. Do I want all my money back from the $77 policy, which is $27,000, or do I want to choose because I got cancer, heart attack, stroke, something that came up, and I don't qualify for that policy? Maybe they say at 69 years old they want to keep the $50,000 policy at no payment because they know that's going to take them through age 95. So that is how we can do a 3-layer policy in to get a $300,000 coverage. So Melissa, the next piece I want to cover with a few moments left here is what I call a half and half. So this is going to end up being roughly the same payment, but the example here would be for someone who says, you know what, I want to have more on that RPU at the end of it, and I'm going to pay about the same, but we're going to cover a little more. It's kind of just doing 2 policies. So in this example, we're looking at a half and half, okay? So the half and half is not talking about coffee creamer. This is talking about half of the coverage being through any form of death and half of it being accidental specific, okay? Accidental specific. So we have that same $300,000 mortgage, right? So we're going to do $150,000 in this example in a 30-year term. And you could do this with or without return of premium. It doesn't matter. If they're more money conscious, price conscious, doing it without return of premium is going to make this payment even cheaper than the way we're going to look at it here. As a matter of fact, Mark, could you do me a favor? Could you run $150,000 on a 30-year term with Mutual without the return of premium, and just tell me what that number is, please, sir? And then we're going to run this congruently with $150,000 accidental policy, and we're definitely going to do a return of premium on that because it's just super inexpensive to do it. So the accidental is going to have the 150. That way, if they pass away of an accident, and you have to be very clear with the customer, because we do the right thing even when no one's looking, we're going to make sure this customer understands that they have to die of an accident to get the full 300,000. But if they die of any other natural causes or anything else that's not an accident, the family still gets the $150,000. Okay. And for these two policies, the breakdown of the payment is 113 here, 31 here, which comes out to 144 with the return of premium on this policy here. Mark, are you able to run that for me, my man?
66.
66. So if they were even more price conscious and they wanted to do it without the return of premium, you could do 66 plus the 31 is going to be 97. So now you're at that, you know, some customers just for some reason think that under $100 is affordable. Again, it all goes back to what your financial fire drill told you, right? So now we're able to go back and help a family get policies that make sense financially based on their financial fire drill and a few different ways to actually couple different policies together. Melissa, do I have time to explain to these folks how a half and half can work as far as our what we call the refi option?
Absolutely. We got 8 minutes and counting until
Okay.
11.
So here's what I love about the what I call the refi option, right? Is let's say you have that $300,000 home. And you guys can put the answer in the chat if you know it. But if you have a $300,000 house, is it going to be $300,000 forever? Or is it just going to be $300,000 today? In other words, next week, next year, 5, 10, 15 years down the road, the 300,000 is never going to be 300,000 except for just right now, right? So it's just today. So let's assume worst case scenario, Melissa. We sell this policy to Jack and Jill. They buy the policy for a half and half payoff, and it's a natural death. So we bring them, the insurance company writes them a check and sends them in the mail the check for the $150,000. This was on a 30-year loan. The loan on the mortgage was, and this was a 30-year term, which doesn't matter at this point because they just passed away of a whatever. So now the balance on the home is only $150,000. Now, yes, we have to assume interest rates are going to be relatively the same, but if I took that $150,000 and I went to the bank and I refied for the same number of years that's left on the loan, 29, 30 years, whatever, if they pass away sooner than later, what just happened to the monthly mortgage payment? It dropped practically in half, right? Because we're only financing half the dollar amount. Now, for you math wizards out there, I know that math isn't exactly precise, but it's pretty darn close. Now, here's where it gets really, really, really fun, is we assume that the person's going to die down the road, right? They're not going to just die instantaneously. And if you guys know anything about amortization tables, you'll understand that a $300,000 loan in about 20 years will be down to in about 20 years, somewhere between years 17 and 20, it becomes about halfway paid off, which means they would owe 150,000, right? So what does that tell us? That means that somewhere along the way, in between years 1 through 20, they're going to be somewhere between $300,000 and $150,000 owed on that mortgage, assuming they never made any additional payments. So for argument's sake, let's just say that this family, when the loved one passed away, let's say that they owed $200,000 on the house, somewhere between probably year 15 and 20. So they owe $200,000. Melissa, check this out. We bring them a check from the insurance company for $150,000. Jack passed away. It was of a natural death, still in this example, because if it was an accidental, he's going to get the $300,000. But this is a natural death. So now Jill only owes $50,000 on the house. We said that, let's just say it was the 18th year, okay, when Jack passed away. So there's 12 years left on the mortgage. If she takes this $50,000 only and refis it for just 12 years, I ask again, what happens to that mortgage payment? Probably becomes very affordable with a one income household, since Jack passed away, Jill can't afford it otherwise. Now you don't have to do a full payoff in order to get a policy that helps that family protect the mortgage. So with that, Melissa, I'm going to unshare my screen. I'm sure there was plenty of questions in the chat, but I'll hand it back over to you.
Absolutely. And thank you so much, Mark, for manning the chat. Thank you, Alex, for pouring into us. And thank you, Symmetry Nation, for tuning in today and listening to these fine gentlemen. We hope that you were able to, grab and pull a few pieces of information that will help you to help more families. And then also, in case Brandon's listening, or for all of you history buffs that are out there, we just want to remind you guys that the oldest known use of the proverb, "You can't have your cake and eat it too," was written in a letter from Thomas, the Duke of Norfolk, to Thomas Cromwell in 1538. And what that means is you can't simultaneously retain your cake and eat it too. They don't coexist. So that means, in ordinary terms, to enjoy the good parts of something without having to deal with the bad parts simply doesn't exist. And so to relate that here to Quility and Symmetry is that you cannot be successful here without putting in all of the hard work that it takes to earn it. So God bless you all. Have an absolutely amazing week, everyone, and take care. Thank you, boys.